Right now, at this exact second, some of the wealthiest corporations on Earth are doing something entirely unprecedented. They are firing thousands of their smartest, most highly educated human workers. But they are not doing it because they are losing money. They are doing it to buy electricity. Welcome to the great economic recalibration. The global economy is undergoing a profound, almost invisible transformation. It is being driven by the accelerating, aggressive integration of artificial intelligence across every single industry you interact with, but what you are being told on the evening news is only a fraction of the real story. We are seeing shifting regulatory landscapes, drastic corporate restructuring, and a massive wealth transfer that is completely reshaping how human labor is valued. Today, we are going to look under the hood of the global market. We will look at the institutional data, the systemic risk heat maps, and the exact playbook you need to survive and thrive in this new reality. Let us start by translating the macro environment. Imagine the global economy as a vast, sprawling garden. For decades, the way we grew this garden was fairly predictable. We hired more human gardeners, but suddenly artificial intelligence arrived. Think of AI like a brand new, highly advanced, super efficient irrigation system. It rapidly changes how the plants, which are the companies, grow, and it radically changes what kind of produce, which are the profits, they yield. But here is the catch. To afford this massive, expensive new irrigation system, the garden owners are cutting back on fertilizer. In the real world, that fertilizer represents human employee benefits, entry-level salaries, and training programs. We are seeing this play out in real time with terrifying speed. Let us look at the financial services sector, which our systemic risk heat map places at a massive 70% risk level. For generations, getting a job at a Big Four accounting firm like PwC, Deloitte, EY, or KPMG was the golden ticket. You graduate college, you put in the grueling hours, and you climb the corporate ladder. But the ladder is being pulled up. In late 2025, PwC quietly announced they were going to slash nearly 1/3 of all their United States entry-level roles by 2028. In their audit departments, they are projecting a devastating 39% drop in human hiring. Why? Because an artificial intelligence model does not need health insurance. It does not take sick days. It can process 1 million tax returns, audit complex, financial ledgers, and cross-reference global compliance laws in the time it takes a human graduate to log into their computer. To understand the sheer scale of this, we have to look backward. History is full of these painful technological transitions. Back in the early 19th century, highly skilled textile workers in England realized that new, automated mechanical looms were going to destroy their livelihoods. They formed a secret oath-based faction called the Luddites, and they famously smashed the machines in protest. They were not anti-technology, they were anti-starvation. They realized that the owners of the machines were going to take all the profits, while the value of human labor dropped to zero. The British government eventually suppressed the Luddites with military force, making machine-breaking a capital offense. The Industrial Revolution marched on, creating immense wealth, but also a grueling, brutal period of adjustment for the working class. Today, the mechanical loom is the generative AI model, and the textile workers are accountants, software engineers, and middle managers. The adoption of AI is not just an incremental upgrade, like getting a faster laptop. It is a fundamental re-architecting of business processes. IDC surveys recently reported that 66% of global enterprises are intentionally reducing entry-level hiring specifically because of AI automation. The corporations are getting radically more efficient. Their profit margins are expanding, which is why the S&P 500 has been hitting new highs, hovering around 5,300. But that wealth is not trickling down to the human workforce in the way it historically used to. This brings us to the second massive shift in the market, and it is something very few people are paying attention to: the sheer terrifying physical cost of artificial intelligence. When you type a question into a standard search engine, it uses about 0.3 watt-hours of electricity. That is practically nothing. But when you ask a generative AI model to write a legal contract or generate an image, it uses nearly 3 watt-hours. That is 10 times the energy. Now multiply that by billions of queries, autonomous agents, and massive corporate models training 24 hours a day. The artificial intelligence revolution is starving for power. In 2024, global data centers, used roughly 415 terawatt-hours of electricity. That is about 1.5% of all electricity used on the entire planet. But by the end of this decade, that number is expected to completely explode. The tech giants know this. They are in an absolute panic to secure the most valuable commodity of the next century, which is not data but raw electrical power. This is where the story gets incredibly strange and highly lucrative for the right investors. Look at the energy sector, which is suddenly surging with IPOs and massive capital inflows. In late 2024 and 2025, Microsoft quietly signed a historic 20-year agreement to purchase power. But they did not buy wind or solar. They bought nuclear power. Specifically, they funded the multi-billion-dollar restart of a reactor at 3 Mile Island, the exact site of the worst commercial nuclear accident in American history. Think about that for a second. The demand for AI computing. Power is so astronomical that we are literally restarting dormant nuclear reactors from the 1970s just to keep the servers running. Amazon did the same thing, spending hundreds of millions of dollars to acquire a massive data center campus directly adjacent to the Susquehanna nuclear power plant in Pennsylvania, drawing nearly 2,000 megawatts of power right from the source. Meta and Google are pouring billions into next-generation nuclear startups. This is the ultimate contrarian investment play. While retail investors are blindly throwing money at random AI software startups, hoping for a quick lottery ticket, the smart institutional money is buying the nuclear power plants and the utility grids that the AI literally needs to survive. It is the ultimate modern equivalent of the California gold rush. Back in 1849, hundreds of thousands of people rushed to California to dig for gold. The vast majority of them went completely broke. The people who actually built generational wealth were the merchants. Levi Strauss selling durable denim jeans, Samuel Brannan selling shovels and pickaxes. Today, the gold is artificial intelligence, and the pickaxes are semiconductor chips, advanced cooling systems, and nuclear energy. This perfectly transitions into the danger of herd behavior. In the current market, right now, retail investors are being bombarded with rapid-fire, highly emotional updates on stock movements. We are seeing speculative sentiment drive massive midday and after hours. Stock surges that have zero connection to a company's actual intrinsic value. People are absolutely terrified of missing out on the next big AI success story. This FOMO, or fear of missing out, creates irrational exuberance. We have seen this psychological trap over and over again. In the 1630s, the Dutch Republic experienced tulip mania. The newly introduced tulip bulb became a status symbol. People started trading them obsessively. At the peak of the mania, a single rare tulip bulb was selling for the equivalent of a massive luxury mansion. People were trading away their life savings, their land and their livestock for a flower. And then, inevitably, the bubble popped, and thousands of people were financially ruined overnight. Fast forward to the late 1990s, and we saw the exact same human psychology with the dot-com bubble. Any company that simply added a dot-com to their name saw their stock price explode, regardless of whether they actually made any money. Pets.com famously spent millions on Super Bowl ads, while operating at a massive loss before completely collapsing. Today, the herd is chasing AI with the exact same blind panic. They are buying the hype without looking at the balance sheets. But sophisticated AI trading, algorithms are literally designed to exploit human emotion. They track retail sentiment on social media, they anticipate the panic buying, and they extract the wealth. This is why the warm insight contrarian strategy is so critical. Instead of chasing the herd, you must look for the companies whose value is temporarily overlooked. You look for the firm that is not just firing its human staff, but actually investing in upskilling its humans to work alongside the AI. You look for the companies with fortress-like balance sheets in sectors that the herd is currently ignoring. Because there is a very dark side to this rapid technological shift, and it is creating a massive systemic risk. The tension between wealth, creation, and social contribution is reaching a boiling point. We saw this recently when the mayor of New York City publicly criticized a major financial executive. While it may have been politically motivated, it highlighted a very real, very dangerous crack in our society. The wealth inequality statistics for 2024 and 2025 are absolutely staggering. Global billionaire wealth surged by $2 trillion in a single year. That is an increase of nearly $6 billion every single day. The richest 1% of the global population now owns roughly 45% of all human wealth. Meanwhile, massive corporations are pushing for aggressive efficiency, cutting entry-level jobs and replacing them with algorithms. If this bullish corporate scenario continues unchecked without adequate re-skilling programs or social safety nets, we face a bearish nightmare. Widespread labor displacement leads directly to a massive decline in consumer spending. If people do not have paychecks, they cannot buy the goods the AI is so efficiently producing. This triggers a demand-side recession. It exacerbates wealth inequality, which historically always leads to severe social unrest and political instability. And political instability instantly deters both domestic and international market investment. Think back to the Gilded Age in America during the late 1800s. You had massive industrial growth and the rise of the original robber barons. Men like John D. Rockefeller and Andrew Carnegie amassed wealth that was almost mathematically incomprehensible, while the average factory worker lived in absolute poverty, working 14-hour days in incredibly dangerous conditions. That extreme imbalance eventually led to massive, violent labor strikes, the rise of unionization, and eventually the government had to step in, with intense antitrust laws to break up the monopolies. Today, the global regulatory landscape is watching the AI boom very closely. We are waiting to see if government actions or shifts at the Federal Reserve will introduce harsh new guardrails. So how do you actually survive this? How do you protect your family and build wealth when the very nature of work and money is shifting beneath your feet? You use the Titan's playbook. You must adopt a strategy that balances the massive growth potential of AI with aggressive risk mitigation. The Warm Insight model recommends a very specific asset allocation seesaw: 55% stocks, 35% safe defensive assets, and 10% cash. Let us break that down. For the 55% stock allocation, you do not buy random AI software companies. You buy the foundational infrastructure. You look at technology exchange, traded funds or ETFs that focus on semiconductors, tickers like SMH or SOXX. Because it does not matter which AI software company wins the war. Whoever wins, they all have to buy semiconductor chips to run their models. You also look at cloud computing ETFs like CLOU, and crucially, cybersecurity ETFs like Bug or Hack. Because as AI adoption escalates, digital vulnerabilities and automated cyber attacks are going to absolutely skyrocket. But you must balance that. Aggressive growth with the 35% safe allocation. This is your shield against the economic shocks. You allocate a portion to healthcare ETFs like XLV. People will always get sick, regardless of what the stock market is doing. And you allocate to the utilities sector like XLU. Remember the nuclear power plants we talked about earlier? The AI revolution cannot happen without the utility companies, providing the massive amounts of electricity required to keep the servers cool. Infrastructure development ETFs like IFRA will also see massive tailwinds from government spending and the desperate need to upgrade the electrical grid. And then there is the global shield. You cannot just invest in the United States. Yes, America continues to lead the world in artificial intelligence, innovation, and corporate adaptation. But Europe is currently at the absolute forefront of AI regulation. They are writing the rules that the rest of the world will eventually have to follow. This creates unique investment opportunities in compliant solutions. And emerging markets, particularly those with strong digital infrastructure and young tech-savvy populations, offer massive long-term growth potential. A tactical allocation to international ETFs like VEA or EEM provides geographic diversification. If the U.S. market experiences a severe regulatory crackdown, your international assets provide a critical buffer. Finally, the most important survival mechanic of all. In an economy undergoing this level of profound, terrifying transformation, you must absolutely abandon the idea of timing the market. You must use dollar-cost averaging. Imagine you need to buy groceries for the entire year. If you buy all of them on January 1st, and prices happen to be at an all-time high, you lose. Dollar-cost averaging means you take a fixed amount of money, and you invest it on a strict, consistent schedule, regardless of what the news is saying. Whether the market is at a record high or in a terrifying free fall, you buy. Over time, this smooths out your purchase price. It completely removes human emotion from the equation. It forces you to buy more shares when prices are cheap, and fewer shares when prices are expensive. If the market pulls back by 5% or more, that is not a reason to panic. That is an action trigger. You step in and increase your exposure to those foundational AI technology ETFs. You buy the dip on the long-term growth drivers. And if market volatility spikes, if the VIX index sustains above 25 for more than 3 days, signaling massive market fear, you augment your positions in those defensive, healthcare and utility sectors. What you absolutely must avoid, your ultimate rule for survival, is chasing the hype. Do not throw your hard-earned capital at speculative, unproven AI ventures just because a billionaire tweeted about them. The AI hype cycle is a dangerous siren song. It will lead to irrational valuations that completely detach from mathematical reality, creating catastrophic downside risk for anyone who fails to do their homework. History teaches us a very clear lesson. Every single technological revolution, from the mechanical looms of the industrial age to the fiber optic cables of the internet boom, brings immense opportunity and brutal, painful disruption. The specifics of artificial intelligence might be new, but the underlying patterns of human greed, fear, innovation, and regulatory backlash are just echoes of the past. Progress is almost never a straight line. It is chaotic, it is messy, and it is ultimately transformative. Today's warm insight is this. In periods of profound economic transformation, immense patience and a disciplined, cold, calculated focus on fundamental value will always outperform reactive fear or speculative greed. The algorithms may be taking the entry-level jobs, but they cannot replicate human discipline.